Well, you're watching Investment Gurus, and in the difficult market that it's turning out to be, who better than Hiren Ved from Alchemy Capital to give us some hope at least, if he has one, that is. Hiren, morning. Great to have you on ET now, and wish you and your entire team a very happy Diwali, first of all.
Happy Diwali, Aisha, to you and your team and all the viewers here.
Thank you. Is it really that cheer and Diwali feeling out there? Because what the index has not done, I wouldn't say done, has just been at the same range-bound kind of feeling. And individual portfolios as well, you know, feeling that pinch a little bit.
Yeah, I think last year has been challenging. I think markets peaked in September 24. And then we've seen several challenges from there on.
All the BTS of a TV studio.
Yeah, I think we've had a fairly longish consolidation phase. And perhaps rightly so, because I think, after very strong earnings growth between, let's say, 2020 and 24, we finally had very tepid earnings growth last year, as also first half of this year, right? So we are still talking about 8-9% Nifty earnings growth. Now, I know that the Nifty earnings growth is not really a representative, because actually all the growth is happening in the next 450 stocks outside of Nifty. But having said that, I think that we are probably at a cusp where in the second half of the year, we should see a rebound in earnings led by growth in consumption, right? So I must say that I've never seen the kind of easing that RBI has done, not only in terms of interest rates and liquidity, but more significantly in terms of loosening monetary policy, right? So provisions were tightened, risk weights had been increased. They're all being unwound now.
And all of it is getting front-loaded.
Correct.
You know, the entire machinery is working to preempt, all the demand, etc., bottlenecks.
Correct. So I think last year we ran a very tight fiscal and monetary policy. I think finally we are letting go, and we've loosened fiscal policy by giving tax cuts. First we gave the income tax cut in February, and now the GST cut, right? And then we've seen significant monetary easing. So my sense is that this combination of fiscal and monetary easing should help to get growth back. I think consumption growth was really limping. I'm hoping at least the early feedback is quite positive when you look at auto sales numbers, etc., durables. I think this momentum hopefully should continue into this quarter as well.
In the past, we've always talked about defense being that one pocket, and defense has gone through its entire cycle. I mean, from that peak that it made last year to the correction thereof, and now, I think it's for everyone to know that you've got to have defense in your core portfolio as well as the rest. But the thing is, what price are you willing to pay for those defense stocks if you were to add on to positions?
So I think I still feel that it's a long-term theme, right? I think unfortunately, we have a very hostile neighborhood. We saw what happened with Operation Sindoor, and I don't think we have a choice there, frankly. I think the government is also realizing that while we need to be more self-sufficient, it is also a tool for encouraging manufacturing, encouraging, job creation, right? You look at the shipping policy. I think there's a big thrust today. So whether it is, defense and naval ships or even commercial shipbuilding, I think there is a big leg up the government has given. So I think that defense is, in my view, is a 10-15 year story. It's, it will go through its own ebbs and flows, but I think it is here to stay, in my view, and it will continue to be a significant investment theme even going forward. I think along with defense, what is also happening is that, as you saw recently, the entire Airbus board was here in India, right? I think that even in commercial aircraft, uh, I'm seeing that a large part of the global supply chain wants to come to India, right? And I think we do have a competitive advantage in aerostructures, for example, right? So I think that it's defense and aerospace and shipbuilding. If you put all of this together, my sense is that there is a lot of money yet to be made in this sector. Many companies are still very, very young and small, and I think they can be 4x, 5x their size over the next couple of years.
What are the other structural themes that you think one needs to have in their core portfolio for the next 10 to 15 years? I mean, a lot of people are now betting big on consumption tech. We've also talked about that in the past. And now you've got so many more listed plays into that bucket. Is that something that one needs to look at, or must have rather?
I think so. I mean, I think the so-called platform companies or consumer tech companies, have done really well, right? And I think that they're a great alternative to the traditional consumer plays that we had, because there is hardly any growth, right? I think what these tech platforms are doing is that they are aggregating demand on one side and aggregating supply on the other side, and delivering phenomenal consumer experience, right? And I don't think that's going to go away in a hurry. And I mean, I see a lot of these companies becoming really big in India. So we continue to be bullish on the platform companies. But here you have to be very clear that it's more likely to be the winner takes it all, right? The number one, maybe the number two player at best. There's hardly going to be a number three, number four in this, right? So as long as you are with the best guy, the best execution, the best scalability, the best profitability, I think that's where disproportionate money is going to be made. So you shouldn't trade down and say, okay, this is expensive, so let me buy the next expensive and the next expensive. In this sector, I don't think you could do that. You have to be with the winners.
One concern here, Hiren, is profitability, right? You're operating on thinner margins.
Yeah.
And as you go deeper into both the product chain, from food delivery to quick commerce, the margins get thinner. And when you're moving from quick commerce deeper into India, your margins also get thinner. How should one look at that? Because the whole play is the large addressable market that we have.
Right.
But nobody's talking about this shift in margins as well, right? Profitability.
Yeah, so I think why some of these stocks have done well is that the investors are now convinced that there is unit economics, right? I think margins getting diluted are a function of growth. So if tomorrow they decide to pull back their growth, margins will come back rapidly. But I don't think that's what these companies want to do. I mean, they want to capture as much of the white space that is available to them. Because as I said, in this business, unlike, let's say, in a traditional FMCG business, if you really go back and look, I mean, the Levers, the ITCs, the Maricos of the world, they took decades and decades to build a very deep distribution, going down to the last village and making their products available today. I think these companies are in a hurry, right? They want to cover the white space very quickly. And once unit economics is established, they know that once they get the volumes, the operating leverage should play out, and that's the bet. And I think a little bit it plays on both sides, right? In the sense that, in the urban markets, you got the density, right? As you go down to the tier 2, tier 3 markets, maybe the ticket sizes go down, maybe the frequency goes down, but even the costs are lower. The infrastructure costs, the real estate costs are not as high. So when you build a dark store in Bombay, right in the middle of Lower Parel, versus you building a dark store, outside of or even within a tier 2, tier 3 town, your costs are very different. Your people costs are different, your infrastructure costs. So I think, and Indian entrepreneurs are very smart. They'll figure out a model which will work for them. And I think, we all, including myself, like I didn't initially think that 10-minute delivery is such a great thing. Like I thought, why would a consumer pay? Like all along we've been
part of our lives and how.
Yeah, I mean, we've been planning our weekly, monthly buying, but I think this was a case of supply creating its own demand. Once the convenience was available and once people got hooked onto the convenience, today you don't think, you need anything, you just, in 10 minutes it's available.
But, that's the other thing, right, Hiren? I think we're in that transitional phase where the old is giving way to the new, and that's happening pretty much in every sector. I mean, call it tech advancement, behavioral patterns, per capita GDP, income sort of rising up. And I remember you were talking about once as to how the exposure from, or rather the shift from exposure to traditional banks is also taking place, and it's finding its way to some of the capital market exposures, for instance, or NBFCs and niche NBFCs.
Correct.
Do you still play on that theme, even though now it's a very well-discovered one?
Yeah, I mean, yes, it's now well established and well discovered than, let's say, when we were talking about it 2-3 years ago. But I think the fact still remains that, the problem is that if you look at overall credit growth, you want to be with the bigger banks because that's where there is quality, safety, scale. Unfortunately, the bigger banks beyond a point can't grow much faster than what the system credit growth is growing, right? So system credit growth is at hardly 9-10%. Let's say it improves to 11-12%. You are a very efficient player. You'll probably grow 200 basis points more than system growth. You can't grow 700-800 basis points more than system growth unless you're a very small lender, and then you don't want to be with the small lender, right? On the other hand, I think the appeal of the capital markets is that, as Uday Kotak himself said, we are moving from being a nation of savers to a nation of investors, right? And I think while the number of demat accounts and the number of investors has really gone up, I still think that there is a lot of penetration still left, right? If you look at the RBI data, I think household savings into equities is still just about barely touching double digits, right? Fixed deposits are still form a very large part of people's savings. So I think this financialization of savings is going to be still a very big theme. The other thing is that the rate at which wealth is being created in this country, right? The fastest growing number of billionaires is in India, now no longer in China. India has the fastest growing billionaire. So much wealth is being created, and this wealth will need to be managed, right? So I think whether it is asset managers, exchanges, wealth managers, I think it's a big secular theme still. Now, that doesn't mean that the banks are bad or you won't make money there. But I just feel that, there's extremely good operating leverage in businesses like asset management or wealth management. Because after a point in time, your fixed costs don't go up and everything flows to the bottom line. You can't have a better return on capital, a better operating leverage business.
Hiren, so we've spoken about three big themes. Talk to us about risk reward stroke valuations, how should one look at it in each of these themes? Because obviously valuations have run ahead. They've factored in at least a couple of years of growth going forward. Which of those look the best in terms of the risk reward? And of course, you've already given us a sense on basket approach versus individual. So that I think is fairly clear to viewers. But how does risk reward stack up? Should we wait? Would you bite in now at these valuations? Give us a sense.
So I think we've seen clearly a two-tier market in that sense, right? I think, it's very clear that market chases growth. And especially when growth is difficult to get by, you get even better valuations wherever there is growth. Now, my sense is that, this kind of very lopsided high valuations will moderate over time because of the kind of supply that we are seeing. There were lack of choices. No longer are there any lack of choices, right? You're seeing so many IPOs hitting the market. There is continuous fundraising in terms of promoter sell downs, PE selling, QIPs, IPOs, right? I think over a period of time, unless a company is really exceptional, where it can command a higher multiple or a premium, I think over a period of time, I think this premium will start to shrink as the choice of good businesses that you can invest in increases dramatically, right? So let's say, I'm just saying, let's say earlier there was only 1 or 2 platform companies. But now suddenly if you have 15, you have a much wider choice, right? And therefore you will start trading off saying that, okay, do I need to pay high multiples to this company because now I have a choice. You equally have great growth and valuation. It'll take some time, but my sense is that, supply of new stock will take care of overvaluation over a period of time in some sectors, But, you go back historically, I think we're already seeing that. So if you are in a hyper growth phase and there are less choices, the valuations are very high. As choices go up, and also some of that hyper growth phase settles into a more moderate growth phase, I think valuations will respond and come down. So you'll have to really take a company by company approach, right? I don't feel or I don't subscribe to the view that definitely markets are not cheap, but they're not crazily expensive as well, right? So you're somewhere in the middle and you have to really pick and choose, what you're betting for and how much are you willing to pay for growth.
Here's hoping to a truce between India and US, and hopefully that will take care of the FIIs coming back, right?
Yeah, I think, again, you never know, but my sense is that hopefully sometime this quarter we should be able to get to some kind of a deal. I'm quite hopeful and confident. I think recently there has been a little bit of thawing of, the relationship. We're again seeing our trade, team going back to the US. I don't think, any other trade deal has gone so much of back and forth, but hopefully the patience will pay off. I think markets, just from a sentiment perspective, I think, markets are waiting for something like that to happen. And if it were to happen, I think it'll be a big boost, sentiment booster, for the markets as well. Perhaps that could be the trigger for finally a breakout of this very tight range that we've been in for almost a year now.
Yeah. That, and here's to better earnings as well.
Exactly. I think earnings more important than the trade deal, though trade deal takes much more, noise, market share, mind space. But you're right, I think earnings is more critical. So if the markets are convinced that the second half earnings will be better, it may not even wait for the trade deal to happen.
Exactly.
Yeah.
Okay, so here's hoping to that, and here's hoping to a better somewhat ahead.
I really think so.
Okay, thank you so much for your time today, Hiren.
Thanks for having me.